Let's just be real for a second. The market right now is a chaotic mess. You've got headlines screaming about global tensions, inflation that just won't quit, and central banks making moves nobody saw coming. And your portfolio, it's probably feeling the burn, swinging wildly from one day to the next. For most people who try to jump into this kind of chaos, it's a fast way to lose a lot of money. The speed and the sheer unpredictability of it all feel designed to make you panic sell at the worst possible time, or chase a hot stock out of FOMO. It feels less like investing and more like a casino where they change the rules on you every 5 seconds. But what if I told you that for a small group of traders, this chaos isn't a threat? It's actually where they find their best opportunities. What if the very thing that terrifies 99% of people, that intense volatility, is the same force that can create powerful trading setups, often much faster than a sleepy sideways market? And what if you could use a simple 3-part framework to not just weather this storm, but actually use its power to your advantage? In this video, I'm going to give you 3 essential rules that will help you turn market volatility from your biggest problem into your greatest asset. This isn't about some magic indicator. It's about adopting a professional mindset. So stick with me, because rule number 3 is where it all comes together, with a concrete plan for every single trade you make. Let's be honest. Have you ever found a stock you really believed in, you bought it, and then watched it immediately drop, forcing you to sell for a loss, only to see it shoot right back up the second you're out? Or what about this? You see a stock going on a monster run, you feel that intense fear of missing out, you jump in somewhere near the top, and almost instantly, the whole thing reverses and your account takes a massive hit. That is the classic trap of a volatile market. It makes you feel like there are a million opportunities a minute, and that you have to be in on the action. But all that noise, all those flashing red and green candles, can push you into making emotional, impulsive decisions. You start abandoning your strategy, you might start revenge trading to try and win back what you lost, and you end up in a downward spiral, totally convinced the market is rigged against you. The truth is, it's not rigged, but if you're playing in this environment without a solid rulebook, it's a recipe for disaster. So, what's the difference between the traders who get chewed up by these conditions and the small percentage who seem to do well? It isn't some big secret, and they don't have a crystal ball. They just operate with a non-negotiable set of rules. They have a framework that brings a sense of order to the chaos. While everyone else is reacting to every little bit of news and noise, they are patiently waiting for their moment and executing a plan with discipline. Today, I'm giving you that framework. We're going to build your rulebook with 3 simple but powerful rules. These rules are designed to shift your entire perspective, from someone getting tossed around by the market's waves to someone who knows how to navigate the storm. Section 1. Rule number 1. Survive. First, profit second. The first and most important rule in a volatile market has almost nothing to do with making money. It has everything to do with not losing it. Your number 1 job is to protect your capital. Before you even dream about profits, you have to make sure you can stay in the game. The single biggest mistake I see traders make when things get crazy is using the same position size they would in a calm market. This is a fatal flaw. When volatility expands, the price swings get bigger and faster. A 2% drop can happen in a matter of minutes, not days. If your position is too large, you'll get stopped out by what is essentially normal market noise before your trade idea ever has a chance to work. So, the first thing you have to do is reduce your position size. If you normally risk $500 on a trade, consider cutting that to $250, or even less. This gives your trade more room to breathe and allows you to absorb those wider price swings without taking a catastrophic hit to your account. But how do you know how much room is enough? This is where a key tool comes in, the average true range, or ATR. The ATR is an indicator that simply measures volatility. It won't tell you which way the price is going, but it tells you the average size of the price swings. Think of it as the market's noise level. If a stock has an ATR of $3, it means it moves about $3 from its high to its low on an average day. In this kind of market, using a fixed 1% stop loss is often useless. Your stop loss needs to be dynamic. It has to respect the current volatility. So, instead of a random percentage, you can base your stop loss on the ATR. A common and effective method is to set your stop at 1.5 or 2 times the ATR value below your entry price. This helps ensure your stop is placed outside the range of normal market chatter, giving your trade a real chance. Rule 1 is that simple. Trade smaller and place your stops a little wider, using the ATR as your guide. Survival always comes first. Section 2. Rule number 2. Become a specialist, not a generalist. In a chaotic market, it's tempting to trade every single thing that moves. Don't. This is a trap that creates endless noise and false signals. The amateur trader tries to chase every flicker on the screen and gets chopped to pieces. The pro becomes more like a patient, selective hunter. They know that in this environment, you actually trade less, not more. You wait for only the highest probability setups, the A+ opportunities where things look to be stacked in your favor. You only need to master one or two key patterns that tend to work well in volatile markets. Let's focus on two of the most effective ones. The first is the breakout from consolidation. Volatility isn't always about huge, explosive moves. It often cycles between periods of quiet and periods of expansion. Consolidation is when the price gets stuck in a tight, narrow range, moving sideways. On a chart, this looks like the price is coiling up like a compressed spring. An indicator like Bollinger Bands will actually squeeze together during this time, signaling that energy is building up. Your job is to do nothing but wait. The setup happens when the price finally breaks out of that tight range with a burst of energy, ideally on a big spike in volume. That breakout is your signal. You aren't guessing, you're reacting to a clear signal from the market that the quiet period is over. The second pattern is the trend pullback. Volatile markets can create powerful, sustained trends. The classic mistake is to chase the trend after it's already made a huge move. That's called buying the top. The professional waits for a pullback. In a healthy uptrend, the price will often make a new high, then temporarily pull back to a support level before trying to move higher again. That pullback is your lower risk entry point. You can look for pullbacks to a key moving average or to a prior resistance level that might now act as support. By waiting for the price to come to you, you generally get a much better entry and a clearer spot to set your stop. If you did nothing else but wait for these two specific patterns and ignored everything else, you could dramatically improve your consistency. Stop trying to be a jack of all trades and become a specialist hunter. And hey, if you're already finding this framework helpful for bringing some order to the chaos, do me a quick favor and hit that subscribe button. We go deep on strategies like this every single week, and I'd love to have you in our community of prepared traders. Section 3. Rule number 3. Know your exit. Before you enter, this final rule is the glue that holds everything together, and it's where real discipline is built. You must plan your entire trade before you risk a single dollar. The most destructive emotions, fear and greed, take over the second your money's on the line. When a trade goes against you, fear tells you to just hold on a little longer, turning a small, manageable loss into a disaster. When a trade goes your way, greed whispers, "Don't sell yet. It's going to the moon," turning a great winning trade back into a loser. The solution is to make all your key decisions when you're objective and rational, before you enter the trade. For every single trade, you need a written plan. It doesn't have to be complicated, but it must include these three things: your entry, the exact price or conditions that will get you into the trade. This is based on the setups we just talked about in rule number 2. Your stop loss. This is your "I was wrong" point. It's the price where you get out, take a small, acceptable loss, and move on. This is defined by the ATR and the chart, like we discussed in rule number 1. It's not a suggestion, it's a hard and fast rule. Your profit targets. Where are you going to take your profits? A pro knows that getting paid is the whole point. A simple and effective strategy is to sell your position in pieces. For instance, you could sell half of your position when the trade reaches a 2.1 risk-to-reward ratio. This does two amazing things. First, it puts money in your pocket, and second, it takes a huge amount of stress off your shoulders. You can then move your stop loss on the remaining shares to your entry price, creating a risk-free trade that you can let run to try and capture a bigger move. When you have a plan, you're no longer making decisions in the heat of the moment. You're just executing a system. If your entry signal appears, you enter. If the price hits your stop loss, you exit. If it hits your profit target, you sell. There's no hesitation, no hope, and no fear. You're simply following the plan you made when you were thinking clearly. This discipline is your anchor in the storm. Summary. So, let's recap the 3 rules for trading in volatile markets. First, survive first, profit second. Protect your capital by trading a bit smaller and using smart, volatility-based stop losses guided by the ATR. Second, become a specialist. Stop chasing noise. Be a patient hunter and wait for high-quality setups like breakouts and trend pullbacks. Third, know your exit before you enter. Plan your entry, your stop loss, and your profit targets before you ever place the trade. Trade your plan, not your emotions. Look, the chaos you're seeing in the market is very real. For the unprepared trader, it's a storm that can sink an account, but it doesn't have to be your enemy. With the right framework, the right rules, that wild price action can present real opportunity. These 3 rules are your framework. They are your plan to bring order to the chaos and turn fear into a strategic advantage. This isn't a license to be reckless. It's a blueprint for being disciplined. Now, I have a question for you. Drop a comment below and let me know, what is the most volatile stock or crypto you are watching right now? I read every single comment.